Hello, everyone. This is the Hartnett Flow Show entitled DeepPeak. Housekeeping. Good afternoon. Hartnett's weekly report is presented two ways: video walkthrough with commentary, which we're doing right now, a visual of the PDF while we're doing it, the full PDF. And the second way, Hartnett's main points will be broken out on the right below, along with pictures contiguously placed. So let's start. Scores on the doors: crypto 7.8%, gold 7.1%, stocks 3.8%, commodities 3.5%, oil 1.8%, high yield bonds 1.3%, investment grade bonds 0.8%, government bonds 0.7%, cash 0.3%, and the US dollar down 0.3% year to date. Tail of the tape: monetary easing is peaking. Global central bank rate cuts in 24 equaled 164 versus 32 hikes. That's in table 1. Thus far in 25, we've had 10 cuts versus 3 hikes. The pace of policy rate cuts has peaked. Chart 3, we'll put that up in a second. Investors should position for a flatter yield curve going forward. A flatter yield curve can be bear flattening or bull flattening. Bear flattening would be if the yield curve flattens from the front end going up. So if short-term rates go up, that's bearish for stocks. A yield curve flattening could be bullish for stocks from the back end coming down. QE will be an example of that. He's not saying which it is, and he's probably smart not to, given that the Fed eased and we got a steeper yield curve. So the market is now looking at yields in a if not then. So if we don't stop inflation now, we'll have to fight it later. Let's see if he gets into that in more depth. The gist of this is one of the main points he's going to make. Why don't we just say his main points so you can get some framework on this? All right. He believes U.S. stocks are at or near their peak. He believes rate cuts are at or near their peak, at least the momentum of their cuts, as you can see in that picture there. He's very focused on PMIs in the sense that Purchasing Manager Index is an indicator of economic or economies heating up, and he believes that they're at a trough. So it would seem that the easy money is going to back off, not just here, but in other places as well. That said, the U.S. will be far tighter than other countries. He actually, his new term is, instead of the Magnificent Seven, it could be the Lag7. He's refocusing on playing long internationals. For about a week there, he was thinking that we would have a broadening of the market domestically, but he didn't really recommend it. He has a clock, if you remember, he had a clock that described where we are, that we were leaving a recovery area and we were in a boom area. And it sounds like he's saying that we're still in the boom. We're in the boom. And that the boom is now going despite the fact that the central bankers, at least in the U.S., are not going to be easing much anytime soon. I do note that he's not mentioning bonds at all here. Although he doesn't say anything negative about them, I wonder. Okay. That's pretty much your framework. That's where he's going with this. And if you're thinking about this from a gold perspective, he doesn't mention gold at all, but he's as bullish, if not more bullish, than on commodities than ever. And he still believes that the dollar is going to weaken. He does give a level that he thinks the the dollar gets below and stays below a certain level, then he thinks all bets are off and commodities could really boom as stocks, potentially rally, but not like they usually do. All right, moving on. The price is right. Manufacturing is troughing. US ISM global PMI to rise from 45 to 50, 2-year contraction range to 50, 52 expansion range in Q1 2025. In English, he's saying we're in a trough of 45 to 50, and that 2-year contraction range should reach out to a 50 to 55 expansion range in Q1 25. To trade the trough PMI, meaning the bottoming PMI, it's best traded via long commodities. There's your boom. Long high yield bonds. High yield bonds are like equities on steroids. Long international stocks. There you go, especially Japan and Europe banks. Long old economy cyclicals, e.g., materials. Long EM, emerging markets, if the DXY index breaks less than 105. Use US tariff noise in Q1 for entry points into trough PMI plays. Starting on the back end, which is the actionable advice, he's essentially saying that tariff talk is globally recessionary. And he believes, at least to an extent, that much of this is noise in Q1, and use those dips as entry points into trough PMI plays. And again, the trough PMI plays are long commodities. So he's basically saying buy dips in commodities, right? Long high yield bonds. I wouldn't add a comment on that. Long international stocks, especially Japan and Europe banks. He gets into that in a little bit. Long old economy cyclicals. Sounds like a rotation domestically into energy and materials and copper, things like that, companies. Long emerging markets if the dollar index gets below 105. Now, in emerging markets, he means all the BRICS, but I really think he's focusing heavily on China here because he thinks they're not done their stimulus yet. And in fact, I think that's one of his specific plays. All right, the biggest picture. U.S. exceptionalism is peaking. This is the piece. This is where he puts it together. U.S. exceptionalism is peaking. The tailwinds of excess U.S. fiscal spending and immigration and the AI CapEx bubble are fading. Investors are all in on U.S. exceptionalism, missing new secular bulls in cheap, unloved Japan and Europe banks. Areas where value outperforming growth stocks. Charts 2 and 6. We'll show those in a second. Note Japan banks still 74% below 1980 highs. Chart 4. EU banks are 67% below 2007 highs. Chart 5. And both are breaking with upside likely in our view. All right, so the charts are going to corroborate his math. The charts are not the reason he's doing it. But he is saying that U.S. exceptionalism has blinded money to going into Japan and European banks, and they have crept into a bull market without many people noticing it. And there's plenty of upside for them to go in it. He doesn't mention China here, but he does mention them later on. All right. Let's pull the charts up, right? These are a little small here. But the left is chart 2. U.S. growth is driven by tech. Japanese value has been driven by banks. So basically, he's saying Japanese value is outperforming tech over there. And over here, our tech is outperforming value. So the dark blue line on the left-hand chart is U.S. growth versus value stocks. The light blue line is Japanese growth versus their value stocks, or banks. When you think about it, banks are value stocks. On the right is the same concept in Europe. Europe value stocks are outperforming their growth stocks. So there's the US chart again. And below that in blue is you have the European tech underperforming relative to their own value. Next chart. He says Japanese banks are now in a secular bull market. Now, if you look at that, a technician would call it a rounding bottom. That's your left chart. And on the right chart, there are probably various wedges you can draw that have been broken. But they're down 74% since 1989. That's what the left chart says. And on the right-hand chart, they're down, looks like 67% since 2007. So all in, he's saying he's got his contrarian shoes on in a big way now. He's saying that the market is very oversold and underpricing in the upside, that people are missing the boat in the US because of their profits in tech. I wrote some notes. Let me just read them to you. Skip bonds, go to inflation problems. Right. He's not saying to buy bonds in this one. Buy emerging markets is back in focus if inflation fighting is now. Right. Okay. And on the equity side, he's very equity contrarian, meaning get out of the US and go contrarian style. Right. Moving on to weekly flows. 24 billion to equities, 17.6 billion to bonds, 0.5 billion to gold, 0.2 billion to crypto, 12.6 billion from cash. Money is flowing into US ETFs, into GLD and SLV again. That's encouraging because the dollar has been nothing but, relatively speaking, strong. So it looks like, quick comment, even though he's not talking about it, I will. It looks like the Trump election hangover is done. The question is, are people buying the ETFs because of the tariffs? I don't know if the American investor is that savvy. So there you have it. Flows to know. High yield bonds, biggest inflow in 3 months. Emerging market debt, biggest inflow since 23. Here, I'll throw a couple of those charts up. I think I have them somewhere. I know they're in here. Here we go. Oh, chart 12. Wait. Does he even talk about that? Chart 12 is U.S. border encounters in 2024 were low, meaning in Q4 2024, we didn't even bother checking in. We just let them in. So who knows? People stopped coming to the border. Let's put it that way. Flows to know, high yield bonds, biggest inflow in 3 months. That's chart 13 on the right. Emerging market debt, biggest inflow since January 23. I'm not sure how to take that. That's chart 14 on the left. Tech, biggest inflow in 3 months. There's always money flowing into tech. So, he's contrarian, but nothing's giving them yet. Although, could be around the corner. Financials, biggest inflow since January 22. That's chart 15. You can see the financials. That's the light blue line over there. That's significant, right? Financials are cyclical. Financials are counter to tech. So maybe he's onto something. Year-to-date flows to know. Cash, money market funds, record Jan inflow 174 billion. Treasuries, record Jan inflow 17 billion. Global stocks, biggest Jan inflow. U.S. stocks, record Jan inflow. U.S. large cap stocks, record Jan inflow. Emerging market stocks, January outflow. It's interesting. If you look at the stock portion of this, that's your tariff conversation. Oh, we don't need to own emerging market stocks. Tariffs are going to kill them, right? I mean, I think the word is, if we were to hit, coming out of Goldman was, if we were to hit Mexico, which I think we did, with a 25% tariff, it would push them into recession almost immediately. All right, let's see what's next. All right. B of A clients, B of A private clients, B of A bull indicator, up to 4.2 from 4.0, and inflows to high beta emerging markets and high yield bonds, tight credit spreads, and bullish hedge fund positioning. Okay, so we're still in the we don't care section of this. It's just updated. All right. Trough PMIs, trough international, peak US exceptionalism. That's the main area for discussion. And I think he has an awful lot of charts tied to that today. Yeah, he's very PMI oriented. So let's do that now. Trough PMIs, US and global manufacturing, new orders rising relative to inventories. Chart 8 on the right. Inventory shipment ratios lead PMIs and indicate US ISM rises from 49 to 52 or 53, corroborated by US regional ISMs in chart 9. All right, so let's stop there for a second. New orders and inventories are pointing to upside in global PMI. So people are putting in orders to buy stuff or to get stuff made, buy raw materials to make stuff. Okay. Inventory shipment ratios lead PMIs. We don't see that, but we have no doubt that that's true. Chart 9. Let's see what he has there. Oh, yeah. Regionally speaking, PMIs are already turning, right? So regionals report earlier, and they're not officially organized federal numbers, but he's synthesizing them. And he's saying it looks good. Okay. Restarting. U.S. and global manufacturing new orders rising relative to inventories, chart 8. Inventory shipment ratios lead PMIs and indicate U.S. ISM to rise from 49 to 52, 53, corroborated by U.S. regional ISMs in chart 9 on your screen. And global PMI to move above boom bust 50 level in Q1. Global manufacturing expansion after 2 years in doldrums, discounted by some cyclicals. See outperformance of U.S. industrials versus consumer staples in U.S. chart 7. I don't think this is a main point for us, but certainly is an interesting chart. But investors should position for trough PMI theme via long commodities. Here's the part that matters.